Hello and welcome to BQ Prime. You're watching Earnings with BQ, and our guest today is Mr. Ramesh Swaminathan, the CFO at Lupin. Welcome to the show, sir.
Thank you. Thank you for having us on.
Lupin's had a great quarter with its margins, profits, a beat on all fronts. Profits came in at 452 crores versus the estimated 258 crores and a loss in the quarter last year. Margins came in at 17.8% versus 4.4% last year. Operating profit rose 422%. So what has led to this performance? And what sort of, how do you view this business going forward for the year?
Yeah, as I was saying, firstly, there has been secular growth across all our markets. So if you look at, for example, America, we recorded the same, in fact, slightly higher than, in fact, Q4 of the previous year. This, despite the fact that there's actually a drop in seasonal products, we were, of course, aided by the fact that we were able to launch Darunavir in the US. Apart from that, if you look at India, it's recorded a very good performance. It's double digit. If you were to, take away this despite the impact of a negative impact of NLEM, so to speak, which actually happened, last year, in the beginning of this year. So essentially, apart from that, the most important reason is the fact that we were able to record a milestone payment from AbbVie for one of our molecules that we kind of out-licensed to them. All of this actually helped in growing the top line, and of course, the gross margins, and of course the bottom line also.
So a question on the milestone payment: if we were to exclude that number, how much has the margin? How much has the margin come in at? And are we in line for the 18% exit rate that we're looking at for Q4?
Yes. If you look at the gross margin expansion, 1.6% was actually brought in by, in fact, this AbbVie, milestone. But apart from that, there's of course other things which helped out. Essentially, as I was saying, there's a Darunavir launch in America. The entire sales mix in America, despite the seasonal products being lower, there's of course the momentum on the India regional front. And a host of initiatives in terms of the cost imperatives that we had been working on. All of this actually paid dividend for us, rich dividends. So there was of course a lowering of overall freight costs and the like. So we think all of this is sustainable from a gross margins perspective, because there are newer products which are coming in, including Spiriva and a few other products during the course of the current fiscal itself. We also had, in fact, a higher complement of R&D spends. So if you look at the EBITDA margins, it's after taking into account the higher R&D spend vis-a-vis the Q4. And of course, there are a couple of one-time elements that crept in. Essentially, the kind of expenditure that have been incurring on on nitrosamines testing the entire portfolio for the impurities, and to the extent the quality assurance the cost on that was incurred there. We also had, in fact, a provision that we had made for business settlement with one of the parties. So all of this actually went into the making of, in fact, the EBITDA margin, and despite that, there has actually been an increase. So we believe that if you knock it off, it obviously would have been higher. In the quarters to come, we expect newer products, and as a result, we do think that's certainly going to step up. Our margin guidance of over 18% certainly stays. We're fairly confident that we'd be in a position to kind of exceed it also.
Okay. That's a positive. So there was also a generic version of Prezista which was launched, right? Which is under 180 days exclusivity. So there's some amount of revenue that's coming from this product as well. Now what happens after 180 days? This is just for understanding the US markets. Also, how is the price erosion there right now? Because you all have had a 10% growth. So is there recovery on the base business, or is it because of the newer launches, like you mentioned, Darunavir? So how is this?
No, that's exactly the reason why we were able to get the step up. Darunavir is actually taken up. But we would be able to sustain this in the quarters to come because there are newer products coming up. Spiriva, which is a much bigger launch, we would be recording from the second quarter onwards. We also have smaller products, diazepam, rectal gel, and cyanocobalamin. So those are products that you'd be launching in the US. So all of this will certainly contribute to kind of stepping up the top line and flow through to the bottom line also. So that's where we are on this.
And so how's the price erosion there?
The price, has been contained because, everybody has been kind of feeling the pinch out there because of, the kind of pressures that we saw, intensity of competition and the price erosion. There have been a lot of, players who have actually laid off parts of their portfolio because it's not remunerative. So to the extent, in some ways, there is a, when there is lesser competition, to the extent there is always, a more salubrious impact on the prices. And there are in fact drug shortages that the government, that the FDA is speaking about as a result of a lot of people giving way on the portfolio. So we do believe that the prices are stabilizing at erosion is stabilizing at high single-digit numbers. And that's perhaps good for the industry.
So one more question on the drug shortages. Does our portfolio have a lot of exposure to the drugs that are seeing shortage in the US? And are we expected to benefit from that?
Everybody has, some portion of that, which plays in. And for example, we have a fairly good, robust, acute therapy product portfolio, and there was a shortage of that, and and there was a good demand for it also in the previous quarter, for example. So it plays in. It really depends on the portfolio of the individual player, and it always helps to have those products.
And so, what sort of revenues for Spiriva are we seeing in this year? You guided for, I think, 140 odd million for the upcoming year, but like, what is sort of revenue that we are seeing this year?
We have not guided for any product numbers at all, so you don't catch me on that. So we have not actually, we don't do that at all. But having said that, given the fact that it's going to be near exclusivity for us for at least 2 to 3 years, we do expect to get pretty good pricing, which will actually flow through from a overall turnover and volume perspective also.
And so there's like you mentioned, there's almost an 8% R&D expenditure that we're incurring. So what is the sort of pipeline that is expected? Because we spoke of moving to complex generics. So if you could help us with what therapy areas we are targeting, how are we taking these things forward? Is it for the US? Are we also looking at other markets? What's the strategy going forward?
That's a good question. So essentially, from our perspective, the oral solid dosage business will, because the intensity of competition being what it is out there, will actually see a lower spend. But at the same time, we're kind of stepping up on the gas when it comes to spends on the complex ones, which includes the entire inhalations portfolio, the complex injectables piece, and in some ways biosimilars as well. And that, I think, would carry the day for us going forward. It's going to be stepped down when it comes to oral solid, but step up on a host of others. But overall, R&D expenditure as a percentage of sales will keep going down, but the absolute numbers would be pretty large as it is.
So I want to understand a little bit about the India business. We've recorded a double-digit growth, and what exactly is keeping up this momentum? Like you mentioned, the NLEM did hit the portfolio a little bit. So what exactly is working? Also, there's a lot of trade generic stocks that's creeping in, for branded formulations, that it could hurt the branded formulations over a period of time. So what are your thoughts on that? Is Lupin planning to enter this category? Or what sort of future do you see in India?
India is, of course, going to be the dominant theme for us at Lupin. It's certainly a very large chunk of our overall turnover. It's over 35%, and we only see that sustaining and growing. This particular quarter, we spoke about pretty good growth, and this is coming in from, in fact, the areas that we have already traditionally been strong in, which is essentially cardiovascular, diabetes, respiratory. But we're also gathering the pace when it comes to therapy areas like GI and women's health. So all of those would potentially be, growth areas from our perspective. You spoke about mass marketing as well, so it's not as though we do have, in fact, our portfolio of products for, in fact, mass marketing. So that would certainly continue. And insofar as the genericization of the as you were, I think the INN portfolio, so to speak, it's going to be it'll certainly be an irritant and certainly in some ways be a spoil sport for in fact the industry, but it's going to be quite some time before it actually takes any big market share from an overall India perspective.
So then do we also intend Lupin as a company intends to enter the trade generics business?
We're already in it, as I was saying, we're already into it.
But what is the sort of percentage that you're seeing from the business then?
It's growing at a fairly healthy clip. And it's an important part of our overall offerings to the market. It's part of the affordable medicine kit, so to speak.
So usually, what sort of margins do we see on a trade generics portfolio versus a branded formulations portfolio? How much is the difference there?
In a general sense, the India business is fairly robust. So essentially, I would not try to it and trade generics would obviously be lower. From as compared to branded generics, so to speak. But it still remains as a portfolio fairly robust.
Okay. Also, so what is the sort of growth that we're seeing for the upcoming years, considering the kind of pipeline that we have? If you could give us a short-term perspective on Lupin.
If you speak about Lupin as a whole, we are working on, in fact, the respiratory portfolio and the injectables portfolio, and we'll have cashier products which will potentially be global products, so to speak, which will be kind of sold across the entire world, either through a direct presence or potentially partnering with other countries for distribution in those countries where we are not domiciled really. And of course, we are working on, in fact, creating the same kind of a possibility with, in fact, biosimilars and eventually with specialty. So we do think that the healthcare business, the pharmaceutical business, has a tremendous future given all of these possibilities.
And are you looking at any organic, inorganic growth opportunities? Is that being evaluated?
We are always on the lookout for propositions which are compelling, as long as there is and it is actually fits into our overall strategy, and as long as it's right from a price perspective, because we believe in calibrate regression on that score, for a cost and not at all costs, so to speak. As long as the value proposition is there, we would be looking at it.
And that will be for which geography? Would it be India predominantly?
This is really on India. But there are niches where we would like to, for example, if you believe that you have to have a strategic, beachhead in a particular country, as for example, we did in France very recently, or for example, we've been buying for specialty in America and the like. Those are the kind of proposals that you would be entertaining.
Thank you so much, sir. It was a pleasure speaking to you.